Happy weekend, and this is my weekend market update. My name is Jeffrey Scott, and this is my interpretation of the market for the week ending April 6, 2025. My email address is hgsidoc@gmail.com. If you're new to my channel, hit the subscribe button, hit the alarm so you'll know when I post these. If you like what I'm doing, hit the thumbs up. If you don't, well, I guess you can hit the thumbs down, but even better, why don't you tell me why? And I respond very well to positive and negative criticism, as long as it's constructive. I couldn't figure out what to do today from the title, so I have three of them. Markets have a tariff tantrum. Boy, was this something. How much more will we fall? Could be 10 or 15%. And what will a bottom look like? So let's take a look at these questions and more as we look at the markets this weekend. Disclaimer, as always, everything I present should be considered for educational purposes only. Anything I recommend's got to be taken in the spirit of education, not investment advice. The intent of the video is to demonstrate the tools of top-down analysis and how I apply them. Trading involves risk. You alone are solely responsible for any investment decisions you make. I may own or intend to buy or sell any stock mentioned in this report. Trading stocks and options should be considered risky. You should always consult with your financial advisors before making trades. And I have tools for multiple platforms, but I'm an independent trader. And just to say the obvious, this week was, especially the end of the week, was really unusual. And it is very, very, very difficult to trade right now. We've fallen a lot. A bounce probably is imminent. The question is it a bounce to a recovery or a bounce like stopping at a rest area on the turnpike before you continue your way down to Florida? And we don't know that answer. I've been trading for a long time. I've been through a little bit of aware of the crash in '87. I went through the dot-com crash, went through the flash crash, I went through the great financial crisis, I went through COVID, and one thing I will tell you, if you've not been through these things before, they really are painful, especially during the moment, but the market recovers. The key is for you to recover, and for you to recover, you have to have money left. And so I learned a long time ago, I don't chase every little bounce. I need to have conviction that the market is done going down or done going down with the velocity and the acceleration that we saw at the end of this week. So I'm not going to give you a long buy list if that's what you're looking for, but let's take a look at the market and try to answer some of those questions in my title. If you like my videos but you want them really short, and especially if you are a wealth charts user, and especially if you bought my tools on wealth charts, go to stocksanddocs.com Monday morning around 8:30. I should have my video posted there using wealth charts. Great tool. And if you want more of my rantings and ravings, just join my Google group. It's free. It's better than free. You join it, I give you coupons. Well, kind of coupons, intellectual coupons to give you discounts on my products. Go to Google Groups, search for Top Down Trader, sign up how you want to be notified, and love to have you. I actually, in markets that are changing, I send out intraday, which I can't believe I was doing this week, but we are kind of historic on some of the things that I'm going to show you, at least historic for the last few years. And know your news and earnings. We don't get a break, all right? It's as if we need to see evidence that the economy is slowing here just right so that the Fed can accelerate rate cuts and feel good about it. We don't want to see that we've gone into horrible economy from the tariff tantrum. So that would be bad if we have big misses to the downside. And I don't think we want more of what we saw in the employment report on Friday, which is, hey, we're still pretty strong, so we don't need to do anything. If you look at what happens this week On the left are all Fed moments. One of them is the FOMC minutes for April 9th. You know, I hate to say this, I don't think anything matters that we're going to see that's dated prior to Tariff Day, Liberation Day. Yeah, liberation of your savings to go back to where they came from, Liberation Day. Um, if you look at the big news of the week, you got CPI and PPI complex. And again, I think what the market needs to see, in my humble opinion, is to come in a little bit weaker, miss to the downside, but not miss so bad that it sends off the fire alarms. Fortunately, we're not going to deal with a ton of earnings this week as we're about to start the next cycle. We always start with things like Greenbrier, a train, um, coach builder, and maintainer, some airlines with Delta, and then on Friday we start to hear from the banks. So not a lot of things there, and I got a feeling that a lot of things may look different, better or worse by the time we get to Friday. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. Hey, if you haven't been here in a while, that's pretty much it for the slides. And let's go look at charts and just a reminder about my Google group. Um, I've changed the format a little bit um, for a number of reasons. I was spending my weekend making slides, and then I came up with my own product that took all the things I put in slides and makes it real time on my desktop. So to me, that was a better way of doing it. So this is what I call the daily performance, and this will be on my desktop all day long. And why? Because it has a lot of stuff here that's really, really valuable to me. It is real time in the essence that if you hit the refresh button in about 2 seconds, it'll refresh. It'll refresh with real time data. Um, I had it streaming on my own computer, and it was a waste of resources. You don't look at it every minute, so why stream it? If you look at the different components, there's really four major windows. Four, you could say five or eight, depending how you break them up. Up here is the real-time updated performance of the ETFs. You may notice that some of these percentages look different than your platform. Um, some platforms vary in how they deal dividend payments. Typically, these percentages match up spot on with CNBC. If we look at what we just went through, let's just rank them by best to worst. It's never a good day when the VIX is at a positive almost 20%, 83rd percentile from the opening range. Volatility is strong. That's not good for the market. We'll talk about if it's high enough in a few minutes. This is a performance not for the week, for one-day movement from the major indices. The worst was the Qs as big cap growth continued to take it on the chin, down 6.21% on Friday, and the Russell was down 4.46. On the week, a little different, but still horrible. The VIX up almost 50%. Wow. And if you look at the 5-day change, just under 10% on the Qs, Russell 9.6, Spiders 9, and the diamonds minus 7.8. And the scary thing, if I remember correctly, the markets were up a little bit going into the April 2nd tariff release. Just think about how much we fell in 2 days. All right. Why is this helpful? Because I know what's going on during the day in the major indices, gives me a sense of what the market is doing. Over here, again, updated during the day, our new high, new lows on the NYSE and the NASDAQ, and then what's the new highs minus new lows, and boy, did they get massively negative this week. And you could see how we're building a wall of new lows and new highs. Excuse me, new lows on both the NASDAQ and the NYSE with almost the absence of new highs. Very weak market. These three boxes are like magic. Take the three indexes, think about the components of them, and ask if we put them all in their sectors, how many sectors were up? Well, the top line, which you don't see, is today, so there's 0, and the bottom line is Thursday, which you don't see, which is 0. There were no sectors positive in any of those industries on Friday, on any of those indexes, rather. If you look at industries, you had 9%, 8%, and 5% were positive on Friday out of about 140. You could see the numbers were similar, maybe a little worse than they were on Thursday. And then you want to know why you didn't have any stocks up on Friday, if you're still owning any? Because only 7% of the stocks in the S&P 1500 were up. A little bit better, 14% in the NASDAQ and 8% in the NYSE. Talk about widespread carnage. I haven't seen it this bad in ages. If you look at down here, you see on the top the S&P 500 sectors, which will be different than sectors built off of those, of course. And you could see nothing was close to good. Interestingly, discretionary and staples were both bad at about the same amount. And on the 5 days, you could see discretionary was much worse than staples. What was the worst? Energy, financials, technology. Interestingly, let's look at the 5-day change and see if staples comes up to the top. Yeah, staples, utilities, real estate, healthcare. The defensive things are supposed to do better in a bad market. Better does not mean good, but clearly these things were, gosh, when you compare, I don't know why energy sits down. Oh, that's because it's at 200. So when you look over 5 days, staples were actually up. Utilities, real estate, and healthcare were all down, but they were down in the mid-single digits. And look at the other sectors. I mean, that's 50-day change. So this is 50 days. And over here on the 5-day change. Sorry about that. It's hard to see, I know for you too, because of the fonts, but 5-day change, you could see where I started. Staples, utilities, real estate, and healthcare were the ones that led, and really, in some cases, less than half the negativity of the others. Over here on my themes, ITB, which has been blasted, was the leading sector on, or leading theme on Friday, and the only one that was positive. Let me make sure that we're on. Actually, I've got to reset that. Check that for a second. Telemedicine and digital was also positive. Those are the only two themes that were positive. If I want to know what was negative, oil exploration, copper, silver, gosh, that was a leader. China, Norway, MLPs, gold, aerospace. And look at 10% downs in one day. So I think this is very useful. It gives you a sense of what the market's doing. It gives you a sense of what's underneath what the market's doing. And these 3 boxes here, or rectangles as they may be, I watch them intraday because sometimes they lead the market. Let's say we get a perfect Monday. What does a perfect Monday look like to me? We drop hard at the open. Margin calls come in around 11:30. Around 1 o'clock, the market starts to reverse. And we end up the day positive or significantly off the bottom. That is a perfect Monday because that is a sign of a short-term bottom, potentially. So what would I do in a perfect Monday scenario? I'm not sure I'll do much until I get a confirmation. But a perfect Monday, I will start to see in these 3 rectangles improvement before the index improves. And that will be a sign. What will I see if we're continuing to go lower? I won't see improvement in the boxes on the right, and I won't get a sense that underneath we're improving. Very, very helpful. Now, my son, Justin, who, it's interesting, I think the older I get, he must think the smarter I get because now he actually listens to me. And if you're a parent, you kind of know what I'm saying. Um, he called me up and he said, how much is my inheritance getting killed? And I said, well, my market timing model had me out of the market. Now, I wish to say that that meant I was totally out of the market. I'm not, because I have a lot of money professionally managed. And professionally money managers might move some to bonds. They may raise a little cash. They're probably never going to be all out of the market. But then he asks, why? Here's why. I talk about this every night. I talk about my timing model. And we'll probably do the video and then come back during the video at the end and start to talk about what this looks like to me. Here is a rolling top on the spiders. Here is a multiple hits on this line and failures, a breakdown below the WMA, and no reason to be long the spiders. This is a weekly chart. Notice my timing model got me out a little early, but it looks pretty darn good now, doesn't it? You look at the Qs. Timing model got me out on this bar right here. You look at the Russell. We've been out since here. Did we get out at the top? No, that's not the point of my timing model. My timing model is to get me out before much of the damage is done. And you got out on the diamonds. All right. But Jeff, that's weekly. What about the daily? The daily model's tougher because it's going to whipsaw. But the daily model, we'll take a look at this. It takes a second to load. A lot of crunching. The daily model essentially got you out here, which you can correlate very closely with that weekly model. Now, the thing that the daily model will do, and the problem with my timing model, you can see the buy sells are on the bottom, is it will whipsaw you if we retrace. But did you lose a lot of money if you went long here and then you got out of the market up here? You may have lost a little bit. You may have had a break even. But what I do is I look at the intermediate direction, which is short on all my major indices. Then I look at the daily direction, which is short. And that tells me there's no point in buying longs. They're counter trend trades. They're going to do poorly unless you think you're at a bottom and you're willing to take that bet. And there's a sign here that we might be there. So right now, weeklies are short, dailies are short. There's been a change in my model, and I'll show you in a second. Notice this green line here, very powerful. That is my 13-week or 3-month new high, new low. When this thing gets down to the low single digits, we're getting to an area that reversals occur. We are at 0 on the Qs. We are at 0 on the diamonds. We are at 3.47 on the Russell, and we are at 6 on the spiders. We are in an area, if you look to the left, you could see most of these pullbacks reverse when we get down to this level. The fact that this one is wide tells you we didn't reverse right away. This one says you don't necessarily not have a double bottom or go lower. But we look like we're near a reversal point there. Here's the change. Even the monthly model now has gone to a sell on all of the ETFs. I think that that is not good. You could see when it's gone to a sell before, it stayed in a sell for more than one bar. So I doubt it's going to reverse immediately. Interestingly, we never went to a sell in March of 2020, and that was because it was really over so fast. And you have to close below the WMA, and we did not close below the WMA. So, weak markets, and I see no reason to keep buying things here unless something changes. Well, if everybody sees no reason to buy things, nothing's going to change very quickly. Let's look at some of the other breadth things I like. The buckets. The buckets are another thing that are giving me a signal that the market's got to be close to a bounce. If you've watched me before, you know that I like to talk about left shifts and right shifts. This is where are the abundance of the stocks in the U.S. stock market. Are they above their midline of their Bollinger Bands, or are they below? And within the top and the bottom of the Bollinger Bands, you could take 10 deciles, and which decile are your stocks in, and then how many are above and how many are below. This white bar is the bothersome bar. 60% 68% of the NYSE stocks are below the Bollinger Band. 75% of the S&P 1500s are below their Bollinger Bands. 68% of the Russell 2000 and 53% of the NASDAQ. That is a level that you see reversals from. Now, nothing is above, very few stocks are above the midline. Again, that's another signal in itself. In fact, on the timing brief, not the timing brief, the daily performance, which I didn't talk about, only 6% of the S&P 15 are above the midline, which is the 20-day moving average, 10% in the NASDAQ, and 7% in the NYSE. Where was I going? I was going to I wanted to show you that. Now, here's something I want to show you as well. So I want to go show slide. 1 second. I've got a number of things sitting up on my other monitor. Just because we are historically oversold doesn't mean we're going to bounce. I think we're so oversold that we're going to bounce. And I am hoping to see that what I described in Monday, limit down at the open and reversal by the end, because that will make me feel like it's time to maybe stick my toe in. What I don't want to see is for us to open up 200 points Monday because of a relief rally and close negative. That is a bad sign. Now, keep in mind, this is unlike any other crash that I've lived through. Why? Because it's a fake crash. All right? I remember when Lehman Brothers collapsed. I remember when I was much younger, on my treadmill, working out, and watching them CNBC talk about how you could put $1 into your money fund and it was worth less than $1. A money fund, CDs, money markets. You put things in there because they're safe. And when they were going down in value, you knew something would give. And what happened is the Fed massively infused, cut rates, and the markets had a massive rally. It just took forever to happen. The other thing, I remember in COVID, the world was over. I bought a house in Santa Fe because I thought I'd never travel. Now it sits there mostly empty because we're traveling again. And I live in Florida. Santa Fe is hard to get to from here. Who knew what would happen? Then think of the rally that we had. The flash crash. I still don't believe it was a fat finger, but that one recovered almost immediately. This will recover too. Here is, and this is the worrisome thing where one of my lines on my title was how much lower can it go? Here we are in 2008. These are the dates. And I want to point out, this is EdgeRater, one of the other tools that does the buckets. This is looking at the S&P 1500, which really is the right thing to look at because it's a mixture of small caps, mid caps, and large caps. And what you see is 40% below the Bollinger Bands, 50%, it's going to reverse tomorrow, right? Well, tomorrow was 70% below the Bollinger Bands. It's going to reverse tomorrow, and it did. You had a little bit of a relief on the 8th. Then you had the 9th, and it went back to 70%. It's gotta get better. And look, we had no stocks above the midline. We're getting close to that point. And then finally, you could see it starting to shift to the right. So the message here is things can get more oversold. Now, you might ask the question, what happened after October 10th in 2008? Let's go look. Let's actually look at the timing model. And I'm going to put a date in here. So let's go here and let's change it to (2008) October 10th. Now this is not going to take us to October 10th. It's going to put October 10th. I think if I did that right, I showed 27. No, that's not what I want. All right. It's going to put October 10th right in the center. So I want to point out a couple of things. Let's get October 10th, which is the day that we bounced. And this is the negative comment. Oh, we'll go to daily. My bad. This may take a few seconds to go back and find the dates we want and calculate 20 years of my stuff. All right, I got to put it back in here. Not everything is going to be active on the indicators. I don't think the 13-week new high, new low is tracking, and the reason for that is kind of simple. If we were to do that, it would take forever every time you load. October 10th, 2008. I know it's in one of these hesitation days. Is it this day? All right, here's October 10th. What happened on October 10th? Exactly what I want to happen on Monday. The markets opened here, way down. They traded lower. They finished higher. That is a reversal. Now, optimally, it'll look like March 9th of 2009, which we'll go look at in a second. Here's the point I want to make. We closed on this date, which was the reversal date, at a spider of 88. God, I can't believe the SPY used to be that little. The low here in November was 74, so we still lost another 15, 16%. So we could still drop from here another 10 or 15%. It wouldn't be any different than what we saw in 2009. Notice my sell signal came in here, and this is not a hard thing to construct in any platform. It's not a hard, fast selling and buying rule, but it keeps me out of bad markets. Stayed in a sell until we got back above here, and then got shook it out. All right, it happens. My goal is to prevent this. It's going to shake me out here, but I'm looking at the weekly, which may or may not have changed for guidance, and then it got us back in for this leg down. Now let's go to March 9th. See, that was not the low. Here's March 9th. Well, I think March 9th, yeah, this is the 6th. All right, this day was the bottom of the market, right in here. Now look how many bars my daily waited till it told me to get back in. Um, if you had bought on this day, you made a lot of money. If you bought on this day, you made a lot of money. If you bought on this day, you made a lot of money. Yes, we could all tell the world that we've called the bottom and we bought the best day. You have plenty of time to make your money back. So one message is follow a signal, build your own timing model, respect it. Another message is, hey, we can get lower even though we get the big oversold. So yeah, expect a little bounce coming, but I'm not sure we're done going down. And then back to the fake comment. And this is where technical analysis goes out the window. If Trump was to say on Sunday, I changed my mind, I'm going to put the whole world at a 10% tariff, I am going to reduce back to 10% all those extra tariffs, and I'm going to invite every world leader in the next 45 days to come visit me and give me an offer to avoid going back. Markets will go crazy up, and that's why you got to be nimble here. So I think it's hard to short right now, to be honest, and I think it is hard to go long until we see that reversal candle. I think cash is a position, and it's my favorite position right now. On the monthlies is something else I want to show you. This has a feel, okay? Does it feel like 2020, two big down bars? And remember, this month isn't over. We're only 1 week in. Will we go much lower and reverse and then go back higher? Could be. Here was a deeper pullback. This is in 22. Remember that one well. Could we be doing that? We can. But this is a long-term chart of the U.S. markets. And not all these will have data going back forever. So if you go back to 93, you've had major pullbacks. You've had major pullbacks. What don't even look like major, but was a significant pullback, flash crash. If you stay alive, you'll thrive. If you stay alive, you'll thrive. You got to have cash left to stay alive. I know I'm going long-winded, but you think I'm going to show you 100 stocks today? Not going to happen. All right, let's look at the U.S. indexes. You can, enough. I've already told the story. This is almost too fast, too much. You'd expect a relief rally to come as we're getting stretched. Notice we're at minus 100 on the high-low jump of all the indexes. So spider breakdown. Let's look at weekly charts too. Maybe we'll look at weekly today. Who says the 200 is out of play? The 200 is 466. We're at 505. 8% gets me down to the 200. The spider, we're at 422. The 200 is at 382. Between 8 and 10% gets me down to the 200. The diamonds, we're at 360, 383. 362 is 20 points. It's about 7 points to get to the 200. The Russell shows just because you get there doesn't mean it always holds. The VIX on the week, massive increase. When the VIX is high, it's time to buy. When the VIX is low, look out below. What you want is this. You want this big reversal candle. Wouldn't it be beautiful if it opens up higher on Monday, trades up, and then has this kind of a reversal? That's what I'm looking for as a signal to tip my toe in the water. And I might, if we get that reversal, just buy some leveraged ETFs to the long side and take advantage of a bounce and get out. And not stay in long, because I think we can go lower. And you can see the dollar came back higher, still closed down in the week, but came off of its lows. I think the weekly charts give you your targets right there. Another 8 to 10% down, and then boy, could we have the mother of all reversals. But my guess is we don't wait to that point, and whether it's Monday or Tuesday, we're so overbought, we're going to get some type of a relief rally. What does good look like? Because I asked that question. Let us go into the JAS layout. I've got one more thing to show you, but I just wanted to show you this. UNG. So you go up in here, you type in what you want. Here's what, to me, good would look like. Not that UNG looks good here. Natural gas has had a massive bear market. If you go back to August the 22nd, and I think this is probably when we thought that Europe would be buying natural gas for us. Natural gas has come down and been hammered. It broke through the 200 and it retested and failed. It retested and failed. And then as you look at what happened, it retest, it retest, it retest, it retest, it retest. It broke above its moving average, retested, and it went higher. That to me is a nice way to see a bottom and one that you can feel comfortable in. We got to get above the 50, and we probably are going to, do we get above it and then retest? And that's where I get my conviction. Yeah, I don't have any conviction on this upcoming reversal. Doesn't mean I won't play and try and tap a bounce and put some extra money into my account. But conviction occurs to me when you get above moving averages and you retest. If I look at market breadth, it's pitiful. I guess that's a way to describe the markets. All right, so this is also crunching a lot of data. I forgot to load it before we started. So look at the down day on the NYSE. We don't always talk about the NYSE. You want to know another reason why we're getting close to a bounce? This little plus is called the bingo. It's a baby out with a bathwater sign. We had one on Friday. We had two on Thursday and Friday from the NASDAQ composite. Both of these are way oversold in the short term. If you look at stocks above the 50 in white, the 20 in green, and the 200 in red, we are at the lowest level on that white going back forever. We are at a reversal point. If you look at the right, the same thing. Then you have new high, new lows, very negative on both. AD line, very negative on both. And up-down volume, very negative on both. So you look at that and you have to say, we're over, the spring is ready to be sprung. The rubber band is pulled so far, it's going to reverse. But what do we have above each of these? We've got the 200. We got the 50. And if I go back to that daily charts, and I know I'm talking all about the market today, but you know what? That's all that really matters right now to me. If I look at, and let's go into the daily chart, and let's blow up the S&P 500, and let's just talk about it. What is the likely thing to happen here? The likely thing to happen is to probably trade up about half of this distance. So get into this level here. We've got gaps to fill here. We got a gap to fill here. Let's say we get a powerful rally and we trade up to this point. Okay, all you've done is you traded up to a falling 17. That's potential resistance. You trade up to here, big potential resistance. We already failed at it once, the 200. Man, it's the mother of all rallies. We trade up to here, the 50. Again, major resistance. I think it's too much work to expect us to recover on this. To me, the best thing that could happen is get above the 200, fail at the 50, and then retest the spider, the 200, and maybe go higher. My expectation is we rally soon. We fail at one of these areas here, and then we go back and we hit the 200. That's my working hypothesis. That will change by the minute. But that's where I sit right now this weekend. So I started the video, and I'm not done yet. I'm almost done. I started the video with 3 questions. Let's see if I answered them. Question number 1. One comment. Did we have a tantrum? Absolutely. How much will we fall? My expectation is that we get a bounce, that from that bounce we will fail at resistance, and that we could fall another 8 to 10% from here before we start to see a real rally. There's no guarantee of that. I have no more of a crystal ball than you do. Therefore, I'm going to be relying on my objective timing system. And my objective timing system will look at what is the market going to tell me. And I'm waiting for the weeklies to recalculate. And this is the worst looking weekly I've seen in ages. And yes, the last time we had anything similar to this is we're going to go back to 22. And this is what I'm afraid of. Are we going to have that massive rally and fail? Massive rally and fail, massive rally and fail. And then ultimately hold its support, just like natural gas, and then go higher. That would be beautiful. So the answer is, do you want to buy here, 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 or on the retest? I'll take retest for 20, please. So what else? Let's just look at a couple of charts because it was interesting what was working. Let's bring in the ones that I thought looked interesting, potential longs for the week. I always build a watch list. That watch list will continue to evolve during the week. Just because it's on my watch list means nothing except I want to track it. So don't get all excited that I found 20 things I might want to buy. I don't just want to buy any of them. But if the market rallies, do I have any themes here that are going to stand out? Here's the themes that I saw that I liked. This is the home builders in general. If you remember from about 40 minutes ago, ITB, let's put an ITB here for a second. Home Builders ETF. Was one of the positive ones, only positive industry group on Friday. And you could see it was up over almost 2%. Underneath that, I found Beazer Homes, which looks like it's potentially going to bounce here. All right, we looked at that one. We got KV Homes. They all look like ITB. Bullish engulfing candle. Now, we're at a bottom. I like relative strength. This here tells me the relative strength versus the S&P turned up. Volume improved. Let's go back and look at Beazer Homes. Same basic story. Bullish engulfing pattern. Volume is good. Relative strength and OBV. How about Pulte Home? Same thing. And then Toll Brothers. And then Taylor Morrison or whatever it's called. Same thing. This one I like even more because it's not as depressed. And look at that relative strength versus the spider. So home builders started to show up. And then another thing that sort of surprised me were retailers. Now, these things have been destroyed. And aren't they the ones that are going to get killed by the tariffs with Vietnam and China? But I guess if you have onshore manufacturing, I'm not sure that Lululemon does. But some of the retailers looked interesting. Bullish engulfing pattern. Positive volume coming in. See that candle? It was a negative day, but a higher open than the close. It closed at 255 and opened at 243. That's why the volume is white. Relative strength's turning up. It's not there yet. Couple in the healthcare, PGNY, probably as good a chart as I saw. It's horrible. It's major sell-off. It's disgusting. But it's above its 200. It's above its 50. It's above its 17. There aren't a whole lot of stocks that if we were looking at this on Thursday, we'd be saying buy, buy, buy. I'm not saying buy, buy, buy to anything. Celsius, another defensive stock. Beverages. This thing's on a nice little move with a bunch of upgrades after a recent acquisition. I talk about McKesson all the time. Yeah, it sold off on Friday when the market just got destroyed. Does this look anything like the U.S. stock market? No, it's something that is healthy. DHI, another home builder, bullish engulfing pattern. Now it's got to get above that 50. But look what happened here. All right. MicroStrategy, a Bitcoin play, kind of looks like it's coiling here. I think from my perspective, again, I'm not looking at going out and finding a lot of longs here. I mean, I'll be very, very clear about that. But I'm building a shopping list. So if we get that rally on Monday or Tuesday, like I think we will, just from a really oversold condition, I think that these are stocks that I might be looking at. In the healthcare space, Evolent Health. Again, it's a horrible stock. It's above its 50. Relative strength has turned up. I don't love these things, but believe me, the market is so awful. This is kind of the best things I could find. Oscar, another one beaten up with actually held up fairly well on Friday compared to the rest of the market. And then we've got the gold stocks, and I got a couple of them here. KGC, probably the one I still like a lot of the gold. Orderly pullback to the 50, and this 50 has been a good place to buy before. And then what about retailers? How about Target? Would I buy it here? No. Is it on my watch list? Yes. Why? Because that's a pretty big reversal. It's a green candle low. It's the lowest low in ages, and it closed up on the day. And again, why did I build this list? Because my guess is that some of these will be big movers if the market bounces on Friday. Why do I have the scanner here? Because I have 4 impulses that I look for to find something that's moving. One of them is, it's simple. I'm not that creative. I'm boring. Volume, momentum, gap, breakout. And the order from, and this is the squeeze. So DHI is squeezing. The first dot is momentum. The second dot is breakout. We haven't broken out yet. The third dot is volume. If you had a fourth dot, it is a gap. And then you have a space, and then you have a timing model called the CPR and a timing model called the early signal. It is mixed. Most of the market's all red. This is relative strength versus the spider, and this is OBV. Over here, I could see intraday how many of my impulse dots have fired. Up to 5. How many have fired up? How many have fired down? Here is my bongo, which is a trending indicator. The daily on top turned positive on Friday. The weekly is still negative. So for right now, that's a retracement in a downtrend until proven otherwise. Then I have 3 short-term momentum. I have relative volume. I like that to be high if I'm buying something, or high if I'm shorting. It just tells you got a lot of conviction. The fact that OBV is a 1 tells me 1 bar it crossed above its moving average, and it's above because it's green. Relative strength is a 2. That means within the last 2 bars, it crossed above, exceeded the relative strength of the S&P 500, and the weekly is a positive for 1. So if I look at the weekly chart, this kind of looks like we're putting in a little bit of a base, doesn't it? Good volume, and you can see we've crossed above on the weekly as well. So lots of ranting and ravings, 46 minutes of why I think we get a bounce soon. Not sure we don't have a further leg down, but I think we can quantify it. God forbid that 200-day doesn't hold. It is dangerous out there to be long in this market. If we get a ferocious bounce, it's dangerous to be short. Cash is, it may be a 4-letter word, but right now it's a 4-letter word that I like. And if you like these crazy videos, I do them often and put them on YouTube, but I often do them and say, let's do it just for my top-down trader group. So I'm just going to leave you with one graphic, one slide, and that slide is consider joining my top-down group. It is free. Yeah, I'll let you know when I have a selling video coming out, or a live trading that's not selling, or coupons or discounts on my products. Join this, and if you don't like it, quit. It's free, and you get coupons, so it's better than free. Have an awesome weekend. I got this out early because I didn't have to look, although I did look at 1,000 charts, didn't have to talk about 1,000 good signals to buy. Be careful.